Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. As a lot of SaaS companies are questions about how fast they're going to grow and when they're going to be able to generate free cash flow, one company that continues to just churn out money quarter after quarter is Dropbox. Now, this might not be the high growth name that a lot of investors like to see, but it's a really sound company and it's one that I'm really intrigued by long term. They reported earnings last week, so I want to dig into exactly what happened and then what we got from management on the conference call and what their moves are going forward. So let's get to exactly what happened. My name is Travis Hoyam. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content. And I want to start with the earnings results. I'll just start here with the highlights the management put out. Revenue was up 8.7% from a year ago to $611.1 million. ARR, or annual recurring revenue, $2.468 billion, up 7.8% from a year ago. Paying users, almost 18 million, continued to rise from 17.1 million in the same period a year ago. So this may not be considered a growth company, but it's actually growing on a pretty steady basis. Gross margin is still incredible at about 80%. And operating margin, this is exactly what we want to see, is a positive operating margin of 13.8%. That was down slightly from a year ago, but we have positive net income. Cash generated from operations was $140 million. And the company actually bought back stock. This is a company that's been buying back stock the last couple of years. So that really is very different from a lot of SaaS companies where there's a lot of dilution in shares. Here's a look at the overall results from the income statement. You can see $611 million in revenue here. Here's that high gross profit margin. And then the company spends most of its money on R&D. This is the thing that I think separates Dropbox from a lot of other SaaS companies, is most of its inbound customers are finding Dropbox themselves. They're not spending a lot of money on sales and marketing, only $119.2 million in the quarter. That's really low compared to a lot of other companies in this space. So that's one of the positives, is that they have a great top of the funnel. Management has said in the past that about 90% of the customers are finding them. It's not actually Dropbox reaching out on an outbound basis. So that's a great business model. You can also see here about $1.2 billion in cash and equivalents, offset by $1.4 billion in convertible notes. So nothing really eye-popping here, but Dropbox continues to add customers, continues to grow revenue, and has really done a good job containing operating expenses. The stock trades at about 11 times earnings. And like I said, management is buying back stock. So this is a really well-run company using their money very prudently, unlike a lot of companies we see in the SaaS space. Now, one of the things that was interesting was a lot of discussion on the conference call about guidance. Management did reduce their guidance in a few areas by about $5 to $10 million. So not big changes in guidance, but they obviously see some headwinds from both a currency basis and then also from customers trying to trade down or save a little bit of costs on their cloud spend. So Dropbox is a piece of that, but they are still expecting growth in the next quarter. So the trends are still moving up, even though guidance is coming down just slightly. The other big change is that management just announced some cost reductions by reducing headcount. Really what they're doing is they're shifting their resources from some of the places that development was happening in the past to more new areas of growth. So artificial intelligence is one thing that they have talked a lot about, utilizing that in the Dropbox ecosystem. Basically said, we don't have the talent that we need to do that, so we need to make cost reductions in some areas and then investments in other areas. That's going to have an impact of actually increasing operating margins this year. So short term, there's going to be some tailwinds because of the cost reductions that are going in place. But over time, that's probably not going to be sustainable because they are going to be adding in other areas. But this is one of those moves where I think Dropbox is thinking long term and thinking about what is this company going to look like 5 to 10 years from now? And how can we leverage the position that we have today, the hardware that we have in place with our servers, and continue to grow and add value to customers? So while this is going to be a little bit of short-term pain, especially from a revenue perspective, long-term, I like what they're doing. So investors are actually getting, I think, a great company here, great value at trading about 11 times earnings. Like I said, buying back stock, operating margins are great. Revenue is still growing. This is not a shrinking company. This quarter was just another step in the right direction. The market's reaction was fairly positive. Stock's up about 6% in the last 5 days as I'm recording. That's not a huge move, but it is an indication that investors are starting to appreciate what they're seeing with Dropbox. But love to hear what you thought about the quarter. Leave those comments in the comment section below. Don't forget to follow Rive Investing. Thanks for watching, everybody. See you here next time.